Well, how a cyber attack could have easily been prevented. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I've got an answer for you. All you have to do is go to prudentmoney.com. Once you get to the radio website, you can see where it says Ask Bob. Just click through and send a question in. If that doesn't handle it, if it's a little bit more of a complex question that's going to require more than a couple of emails, feel free to go to my calendar, pick a time, and we can have a phone call, a little bit longer time together and figure out what the answer is and get you taken care of. There's no strings, there's no cost. It's just an effort a resource that we put together to make sure that you are getting your questions answered today. That's all at the website, www.prudentmoney.com. Well, maybe it is time to listen to the experts and take cyber attack prevention a little bit more seriously. This is a little bit disturbing because you look at a company like Change Healthcare, we talked about this on Friday. Change Healthcare is owned by United Healthcare, and they handle a lot of the systems for billing and tracking of claims and this kind of thing, and basically making sure that doctors get paid, which is a problem that they're having right now. And they had a massive cyber attack. Now, what's disturbing about this? It says you have AT&T with their massive cyber attack. 77 million people estimated were affected by this. That tended to get people's attention, but this Change Healthcare, which looks like is going to be bigger than AT&T, is just getting a little bit of press, and that's it. And at some point, the news of the and this is great for the thieves who are coordinating these cyber attacks. But at some point, the story is going to fade off into the distance and nobody will know about it. But the problem is all the information from the cyber attack is now wherever it goes on the dark web or wherever it gets bought and sold. And so that creates the problem. And so the way that you combat these cyber attacks is by every individual learning the things that you have to do to protect your information online, your personal information, financial information, all that type of thing. They said, you've heard of the phrase two-factor authentication or multi-factor authentication. That's where, and I am by far no cybersecurity expert, but it's, from my understanding of it, it's where you have to sign in a second time. So you can't just sign in one time and get in. It takes two times, which makes it harder for cyber attacks to happen. This Change Healthcare did not have that in play. They did not have that second sign in to make it harder for someone to execute a cyber attack. And that's caused just tons and tons of problems and more money than you can imagine to try to fix the damage. And the thing, the problem is that it's a ransomware attack. And this is also, I found out this morning, and I hadn't read anything about this, is that this also happened to Tarrant County. I think it was a ransomware situation too, and they had to pay off millions of dollars to get their system back running again, but I don't even think it is running again, and has caused a delay in taxes owed, property taxes owed, from what I understand. So, boy, it just seems like that they're happening over and over and over and over again, whereas there's not very much distance of time between the one occurring and the next one occurring, and they're bigger. They're much, much bigger. So what do you do? This is the thing. It's not too difficult to protect yourself. The very first thing that you need to do is verify that everything is correct on your 3 credit reporting agency files. Make sure that everything is correct, and then lock them up by freezing each one of them. And when that happens, when you go through that process, and all you have to do is go to the 3 credit reporting agencies, and I think you can do this just online, and lock up your credit report, your credit file, and then you create a code, and you're the only person that has that code, and you're the only person who can unlock it. And so it is a very effective way to keep people off of your credit files and opening accounts in your name. So that's the first thing that I would do. The second thing is, and I call it the golden rule of identity theft protection, and that is if anybody approaches you and anybody, they call you, and an approach would also be an email, a text, anything like that. You do not click through, you do not answer it, and you don't take it seriously. You don't blow it off though, because anytime, for instance, anytime you get anything from the IRS, it's typically in that matter, it's typically a scam. Because the IRS doesn't communicate that way in fact, most major companies don't communicate to where they approach you. And so yeah, they through emails and texts and things like that, they typically send letters. And even then, you have to call in and verify that you're calling the right number. But you just do not respond to the text or to the email, and that's the first thing. Always just call. So let me give you an example. Let's say that Citibank sends you a email that says there's a problem with your account. Instead of clicking through, call the real number for Citibank and tell them that you just got this email. You're verifying if it's correct or not. Probably isn't. And make sure that, and you can check from that standpoint. So it's just very, very important that you're not quick to click through anything. And what's interesting is that the vast majority of these identity theft methods, they look very real. In fact, there's been some that I've almost caught myself checking, and then realizing, wait a minute, I need to listen to my own advice. Because it seems like, it's one of those things where you got a lot going on, you get that email, it sneaks up on you, and you react emotionally, which means you take action by clicking through. So you just be very, very careful, because that's how, I heard it said once that the strength of a company's cyber attack prevention comes down to the weakest employee. Because all it takes is for someone executing a cyber attack to get through one portal, and then they're in and they do all the damage that they do. But it does seem like it's getting worse. There's more of them happening. Like I said, they're happening at it's not much space and time between when they're happening. So it's just extremely important to be smart about it and make sure that you're not going to be on the other side of the consequences of ignoring the risk. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. Well, the FDIC, the Federal Deposit Insurance Corporation, the federal agency that we look towards to cover bank assets in the event that there's a bank failure, slid one under the door the other day by implementing new rules This to me did not get a whole lot of press like it should have, but I want to make sure that you know about it. And it's for wealthier people, but basically the new rule capped what the FDIC will insure in a trust account to 1.25 million. Before they had this set up, before they changed it, there was no limit on trust accounts. Now, so you can imagine, you take a trust account, you put it in a bank, and there is no limitation on insurance if the bank fails. What was interesting to me is that they said, the FDIC said the new rule will make it easier for consumers and bankers to understand deposit insurance rules. It is also designed to help FDIC agents more quickly determine which accounts are insured after a bank fails. Do they need a new rule to do that? That's what, and maybe so, because you really have to dig deep to figure out what's insured and what's not insured. It's just like the IRS and the IRS code. What I always advise is talk to your banker and verify what you think is insured to make sure. Now, we've got some conflicting messages going, though, that comes in from the government, because right now, and the way it's been for a long time, ever since the financial crisis, is that they insure up to $250,000 on as far as the limit on an account. We'll talk a little bit more about that here in just a second. This is Bob Brooks. We are up against a break. Stick around. I'll be right back. This is Bob Brooks, host of the Prudent Money Radio Show. You know, I think that I am like most people when it comes down to webinars. Find a webinar that I know I should sign up to watch. I sign up for it, and then I let another task prevent me from watching it. Don't let that happen this time, and let me tell you why. My goal is for this 30-minute educational mini workshop, as I call it, is to teach one concept. How do I know that it's worthwhile? Well, over 32 years of working with investors coupled with hosting a daily radio show allows me to see what investors are doing right with their 401k plan and what they are struggling with. With the threats of risk all around, wouldn't it be nice to know you have a strategy in your back pocket to help you fight off risk with your retirement? The ability to protect your retirement accounts is the missing piece. I want to invite you to a 30-minute webinar that will be held at 11:30 on the 7th of May and the same webinar at 12 noon on the 9th. Today, I believe that managing risk could be the most important aspect of managing your retirement plan. Come and join me. Register today at www.prudentmoney.com.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Hey, I want to make sure that you heard that promo for the webinar that we'll be doing tomorrow on Tuesday and Wednesday. The one on Tuesday is at 11:30. It's a 30-minute, I call it kind of a mini workshop, and it addresses one thing. It addresses risk in your investment accounts or risk in your 401k plan. And I'm going to show you how to go about putting together a risk protection type strategy. Do not worry, this is not going to be hard to understand. I think it's one of the easier things to understand. So go to prudentmoney.com and sign up. It's either for the 11:30 a.m. on Tuesday or the 12 noon on Thursday. We're trying to get a good feel for what these midday seminar or workshops could look like from the standpoint of what's the best time. And if you've got an opinion on that, you can always send us an email and weigh in, info@prudentmoney.com. But this is an important one. You know, if you're like me, I hate to admit to this, but it is the truth. I'll see a webinar and I'll think, man, I really got to watch that. I need to sign up for that. and I go ahead and sign up for it, and then I end up not then I end up not attending because something else came up, and I allowed it to become a bigger priority. So very important that we take the time to learn and understand, and that is it's also, I believe, a stewardship issue that we take the time to understand and learn how to protect, to manage what we've been blessed with. And so I promise to make it worth your while. And I think this is information that you can definitely use and put into action today. So, or tomorrow after, or Thursday. So make sure you go to prudentmoney.com and sign up for it, and we'll take you from there. So look forward to you attending either one. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. So we were talking about bank failures and losing beyond, accounts that you have that are beyond the $250,000 limit for FDIC insurance. And by the way, even though what I'm about to say and talk about, please make sure you're following your bank's guidelines and not depending on what I'm talking about to continue to happen, because I don't believe it will. But 6 banks went down last year. And basically, I'm not sure if all of them did, but I'll say this. I did not see any reports to where depositors lost money. So that was the upside. So which in a sense, what they did is they had JP Morgan, I know for one for sure, took over, I think it was Signature Bank or Silicon Valley Bank, one or the other. And I think that these middle-sized to small banks got picked up and covered by other banks, kind of like what they do actually in the insurance company business. If an insurance company defaults, typically the assets are taken over by the bigger insurance company. Now, having said that, they had to have covered the losses, because there would have definitely been, according to the rules of the FDIC, there would have been losses. But they covered that at 100%. This is not something that, there's a whole lot of press on, but if you look at it and you do the math, they covered it. They went beyond the 250. Now, once again, don't make the mistake, because I think it would be, of counting on that. Follow the rules and make sure. But this New York Community Bank, this is a bank that we've talked about a little bit over the last couple of weeks. Back about a month ago, they had to have $1 trillion plus injected into the bank. This was in March, actually, to keep it afloat. And here's the key to a bank when a bank gets closer to bank failure. It's about controlling the optics. It's about building confidence. It's about telling your banking customers everything's just fine. Don't worry about it. Because what the bank cannot afford to happen is deposits start leaving. Then you get somewhat of a run on the bank, and then it's a huge problem. This is what was happening to these 6 banks that went under in 2023. And New York Community Bank didn't do a very good. Typically, if you're going to release bad news the day that you release your earnings for the prior quarter, you're going to warn warn Wall Street this is going to happen. Well, New York Community Bank took a $800 million loss. And it had to do with, on a commercial real estate standpoint, we'll call it a sector of commercial real estate, but I think that's a big title for a lot of different types of real estate. The commercial real estate market, which is really a massive problem, And the problem is it's a little bit up from the problem of COVID when you started seeing people working from home that continued, that's really never stopped. And so now you don't have as someone who running a company, you don't have all the need for space. And so you have people handing the keys back to these buildings. You have uh, companies going into foreclosure. The building that we're officing in is actually in foreclosure, and it's a big mess. But the problem is that, so you do the math with me for a second. New York Community Bank just reported an $800 million loss. That is, and I don't know how the numbers stack up, but they received over $1 trillion to keep the bank afloat in March. Now they're showing an $800 million loss. At some point, it seems like this is going to dwarf that bank. And I told you last week that if you went and you looked up who has the highest savings account yield in the country, it was this bank, which is the last place I would go and put any money with, because this is what ends up happening with banks, is that they act as if everything is okay. Then all of a sudden the emergency happens and crisis happens and people make a run on the bank. It happens so very, very, very quick. But the risk of default in the commercial real estate market is growing as office and retail property valuations, they're looking at a valuation, in other words, how much they're worth, dropping as much as 40%. At the same time, nearly $1.5 trillion in debt is due for repayment by the end of 2025. And like I said, this is in the early stages of being a problem. And so it'll be real interesting to see what ends up happening with this situation. And but as far as, be real careful with the companies and the banks that are offering the greatest high yield savings return, because if you've never heard of them and they're offering it, you might want to tread lightly on that offer. In fact, when you can go to the Fidelities and the Vanguards and the Charles Schwabs of the world, not to say that they're any safer, but at least you know a little bit more about these big brokerage companies than you do some of these obscure banks. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. One of the things we're going to go over on the webinar is how interest rates and bonds actually work. And I've gotten a question on, the high yield savings account. How do you find where you can get the best rates, and can you get those rates at a bank? Typically, the banks are not offering, and this is the problem. They're still offering CDs that are near the higher rates that the big brokerage offices are offering, like the Fidelities and the Vanguards and the Charles Schwabs. But they're only doing it for a limited amount of time, and they're doing everything they can to keep money from flowing out of these banks. And so they're not quite what your brokerage company houses are offering, but they're up there. But the problem is they're locked up like a CD, because they are CDs, most of them. They're not high yield savings accounts, but they are CDs. And unlike a high yield savings account at a Fidelity or any company like that, and I'm not recommending or anything of that nature, I'm just using them as an example. The money is liquid, always liquid, versus a bank. It's not always liquid. There is a limit on when you can get your money out, and the loss of interest that you would incur when you get your money out. But what you'll see, and this is what I love about doing webinars and workshops, is that it's much easier to explain and go through what is happening with interest rates what happens if they raise interest rates or lower interest rates? What's that look like? How does that affect you as the investor? How does that affect you as the consumer? And it's having a pretty damaging effect all across the board. But we'll obviously be looking at all that and getting you up the curve. I think that's important for you to know, and a lot easier to do when we're putting visuals with it. So sign up for the webinar at prudentmoney.com. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.